Hello, everyone. I just wanted to talk to you guys about one of our trade plays in Dojo Trading. So we have trigger trades, which is used for day trading or swing options. Usually for day trading, we use a 1 hour, 4 hour daily, or even 30 minutes. And then for swing options, we can do daily or weekly triggers. So for this topic, we're going to talk about triggers, respecting cut loss or stop losses, respecting the targets as acting as a support or resistance, and gaps. So we're gonna go over first just the basics of trigger trades. So over here in DDOG, so our trigger is at 136776. So our setup is gonna look like this. So basically, what it means is like if the price is above 13676, which is right now it's a 13636. Once the price is above 13676 or crosses this, it means that we should be getting an option at the money option for a 1 to 2 or 3 days hold for a 2 to 3 weeks expiration. So like I said, by the time that the price crosses this, that's the time that you buy. And then your cut loss will be 13624. So what happens when this crosses up, you buy, and then if it does reach the first target, then that's the time that think about selling or adding more positions. But usually the first target is almost guaranteed that's gonna hit, almost guaranteed. But it doesn't mean that it will not reverse from there. It can keep going up, but first target will always be a good place to exit, at least in a conservative way. So we'll play this out. So by the time this crosses, you buy the contract already, and then just let it play out. So I would set up your alerts already ahead of time for your target one at least, so you know when to kind of exit or exit whenever you want to exit. And also I would set alerts for the cut loss. So in case like whichever hits first, then I would exit using that or just let it run. Hit the first target, second target. And basically that's all the data for this one. So this one's a win. You got your first two targets at least. The more impulsive it is, the faster it goes up, the more expensive, or you can get more gains from this move itself versus like small moves like this. But of course, like because of the price going up as well, that will also factor in on the price of your contract. But yeah, so basically by the time it crosses the trigger, you buy, and then you sell the first target. These targets are basically serves as guidelines. It doesn't mean that you have to sell there, but the cut loss is very important, because if it does cross the cut loss, the reason there's a cut loss is because it acts as a support. If it breaks down, usually it takes a long time to even get back up. So I would exit right away on the cut loss. Another example for Moderna. So our call is 378.98 and the put is 370.64. Triggered up here. They already hit the two targets, hit the third target, and at the end of the day, it hit the fourth target. And this was one of our trades that we did last week. So you could have exited at second target because that was pretty fast. And then kind of lingered around here. You could have exit and get a win already, and then let maybe one or two or whatever a runner contract to let it run and see how far it goes. But for this split trigger right here, this is what we call a split trigger. You would you basically buy a call here if it crosses this, or if it crosses the bottom. You don't have to learn the chart. You could just like look at your or set an alarm on your app, and if it crosses this number, then you start buying a call, and vice versa. If it crosses this 370 64, then you buy a put. And then, it's the cut loss for this one. So if you buy a call here, and then if it goes down, your cut loss will be the put, and vice versa. So if you bought a put, your cut loss will be your call trigger here. So just do the opposite of, So from here, that was a successful trade, even hit, all 4 targets, which is really good. And for your target here, this was a put, what do you call this? A put setup. And we'll go from here. So that triggered, but it went back up. So that was kind of like, scary there. You almost hit the cut loss, but it kept on going down. And this was one of our day trade last week. And it did hit perfectly on the 4th target down here. And these targets, like, don't take these lightly. Like, these targets are serving as resistance. I mean, support at this time. That's why a lot of these prices lingered around these levels, because this acted as support. So next topic we're gonna talk about is respecting cut loss. So this is a BBY Best Buy. This was kind of sad. It did look very bullish from here. However, and it did trigger the trigger, but it got rejected. Like I said, all these triggers, this targets serves as a support or resistance. So they can, they can do a fake out, like break and then just reverse. So that's why you need to respect your cut loss if that's the, if that's what, if that's what's going to happen. So we'll see how this goes. Triggered over here and just kind of lingered over here and hit the cut loss. I would have exit here already. And then this kept on going down. So this was a total loss. I mean, it can still go up, but then you don't know when it's going to go up, right? But our setup for this one was buy over here, which kind of just brushed with it for a little bit, and then it reversed. So our next topic will be respecting targets as support or resistance for possible reversal. So what this means is, like I said, like when you hit the first target, it can possibly reverse from there, because this acts as a support for this one. Since we're buying a put, it's going down. These targets are supports. So this is for Costco, it did go down to the first target. So hit the first target 3 times, and then it got rejected. For anyone who knows price action candlesticks, this is a really bullish candles right here, for almost like a doji here, or a hammer, and then or a spinning top, and then it's another spinning top here while going downwards. So, and it got rejected, and it finally broke through the cut loss over here. So like I said, even the triggers serves as a support and resistance. So you gotta be careful. You should not take these lightly. So I usually like to exit my first or second targets and go from there. But you could have runners and let it run, or if you feel like if you think that the stock will go farther, then go for it. But I would manage your risk by respecting your cut loss if you do go that route. So, and this gaps are special. So gaps actually don't cross the trigger, and you have to make that decision if you want to buy the contract, but you have to be fast on this, to at least get to the first target. But if it does gap up, I usually stay away from it, just because what happens is, like, when it does gap up, it can go up here and then it can just go down straight right away pretty quick. So it goes up really fast, it can go down really fast as well. So sometimes gap ups are a little it depends on your trading experience, but usually when it gaps up, usually what I like to see is a retest. when it gaps up over here and then it dips down for a little bit to test the trigger and then reverse. So, or even go down and then hit the trigger and go up. So, but I like when the stock prices itself or the candle crosses the trigger versus buying a gap up. Because a lot of those gap ups can be fake, can be a pump and dump. So you just have to be careful. But for this one, for the DOQ, you actually gap up pretty quick, and then you can see the volume over here. So it was a real push. It was a legit gap. So but that's a different topic from there. But yeah, so for the gap ups, I would usually avoid it unless you're comfortable playing it. Then you go for it. This one gapped up really fast, and then yeah. So this one never even crossed the target. So I would be careful with these types of plays just because you don't know how far it goes up and then it goes down right away. This is a little risky play for gaps, so I would be careful. There are times that like there are gap ups, like it will gap up here, but then it will cross the trigger. Those are still good, but for stocks that would just gap up above the trigger without triggering the trigger, I would kind of be careful with that. You can still play it, but it's really risky, and it's really up to you based on your risk tolerance. What I like to do sometimes with those is, like, when it gaps up, I would like it to dip a little bit first and then start from there. All right, guys, those are the triggers. Just make sure that buy at the trigger, respecting the cut loss, respecting targets, because they can reverse from there. And then the gaps are specialized trading, so you kind of have to get really learn how to do this. But there's always other trade setups. You don't have to trade whatever that's potentially good, but there's a lot of different trade setups. So if you miss one, that's okay. There's always the next one.